Hi guys. Today we will analyze Lockheed Martin stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Both the short-term and long-term trends are positive. This is a very positive sign. Support level is around $385. Strong support levels are around $346 and $336. Be careful, there is not too much support between $385 and $346 levels if the stock goes down. Strong resistance level is around $400. In the last month the stock has been trading between $365 and $399 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 1.8 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 7% per year, for last 5 years. We see that the average profit margin of the stock has been around 9% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 125% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Lockheed Martin Company: bad, average, and good. First scenario. Lockheed Martin will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 6%. Future free cash flow to net income rate would be low, 50%. In this case, the fair value of the stock today would be $188. Second scenario. Lockheed Martin will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 6%. Future profit margin would be average, 8%. Future free cash flow to net income rate would be average, 55%. In this case, the fair value of the stock today would be $285. Third scenario. Lockheed Martin will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 10%. Future free cash flow to net income rate would be high, 60%. In this case, the fair value of the stock today would be $410. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 22.76. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Lockheed Martin, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 15. Again, I will use 3 different scenarios for Lockheed Martin Company: bad, average, and good. First scenario. Lockheed Martin will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future P/E would be low, 12. In this case, the fair value of the stock today would be $140. Second scenario. Lockheed Martin will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 6%. Future PE would be average, 16. In this case, the fair value of the stock today would be $222. Third scenario. Lockheed Martin will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 20. In this case, the fair value of the stock today would be $328. As you can see, today the stock is overvalued, $386, even if we expect the company's high performance in future. The company has a great profitability rating, but there are some minor concerns on its financial health. The stock is currently overpriced, and its future growth will be slow in 2022. I own this stock and I like it. I will buy more when the stock drops below $330. Company strengths. Lockheed Martin is the world's largest defense, security, and intelligence firm, and is also an important supplier to NASA and other non-defense government agencies. The company is organized into 4 businesses: Aeronautics, Missiles, and Fire Control, Rotary, and Mission Systems, and Space Systems. All segments except Space posted revenue growth in 4Q 2021. The company has consistently delivered positive surprises to the street in recent years, regardless of whether defense spending is rising or falling, or the White House is occupied by a Republican or Democrat. The company has a return on assets of 12% and a return on equity of 57%. This is amongst the best returns in the industry. Its profit margin is 9%, this is better than the industry average. Management plans to spend aggressively on share buybacks during the upcoming period of slower growth. Risks. The company recently conducted a strategic review and concluded that near-term revenue growth opportunities were limited, but the longer-term outlook remains upbeat. The continuing effects of the ongoing COVID pandemic and extended delivery timelines across the supply chain, moderating growth rates in the U.S. defense budget, shifts in customer priorities driven by recent events such as the withdrawal of U.S. forces from Afghanistan. Lockheed is a key supplier to the U.S. military, approximately 70% of total net sales, and thus vulnerable to debates over and potential cuts in domestic and international defense spending. The company is subject to a number of procurement laws and regulations, and evolving U.S. government procurement policies and increased emphasis on cost over performance could adversely affect its business. Lockheed is the prime contractor on most of its contracts, and is also dependent on subcontractors and suppliers. The company is under constant pressure to build its backlog. Compared to an average industry debt-to-equity ratio of 0.17, the company requires more financing than its industry peers. 88% of its industry peers have a better debt-to-equity ratio. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 3% on average per year. The company will show a small growth in earnings per share. The EPS will grow by 5% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.